Chapter 4 in financial accounting, we move on to merchandising operations. So basically any place that we as consumers go in and purchase, products is a merchandiser. So all of your big retailers are merchandisers. So almost anything you think of is going to be a merchandiser. So the key to them is that they're selling you a product. So they will have two components. They'll have to record the sale, and then they'll also have to record the removal of that inventory. So what happens is the sale obviously goes into our net sales, and we're going to talk about some different items that take the sales down to net sales. And then there is going to be a new account called cost of goods sold. So the inventory that they sell you, whatever their cost was in that inventory, is going to get charged off to cost of goods sold and then taken out of inventory. So then the net sales minus the cost of goods sold gives them gross profit, because obviously what the store pays for the product is less than what they sell it to you, the consumer, at. Then we'll subtract out all of our operating expenses to equal net income. So then you can kind of see there's one more step. Like this was our income statement in chapter 3, just revenues less expenses. Now we're going to have net sales minus our cost of goods sold gives us gross profit less our expenses provides us net income. So the cycle is obviously they're going to purchase inventory, they're going to sell it out to customers. Could be in cash, but might be on credit. Then they're going to send those customers a bill, and then they'll collect the cash. Now what we'll have is we'll have a beginning inventory. We'll have purchases for that period, and that will be our goods that are available for sale. And then they will either be sold out to customers or remain in our ending inventory. So maybe we'll have problems that they tell us what the ending inventory is. So then you would know, well, the remainder must have been sold out to customers, or they'll tell us how much was sold, and then you'll have to know, well, then the remainder must be in my ending inventory, because those are the only two places they can go, unless there was theft or something like that. Then we'd have to write those off in our adjusting entries. I feel like most of our retailers use perpetual systems with all the barcodes and the scanning. So as their goods come in, they scan them and put them into inventory through the barcoding system. Then as they sell them out, they scan them and again, take them out of their inventory and then charge them off to cost of goods sold. But I'm quite sure there's definitely adjustments that need to be made, especially with all of the self-scanning where you can easily double scan something or forget to scan something. So I'm sure there's adjustments that need to be made. What we will do is our periodic system where we're going to look at the end of the period and again, either determine what inventory is left and then the remainder must have been sold out to cost of goods sold, or what inventory was sold, then the remainder must be left in our ending inventory. So we can purchase inventory without discounts, maybe a vendor that isn't providing us any discount opportunity. So if that happens, we debit merchandise inventory, which is a new current asset, and then we would credit cash. Now, many times though, we will pick suppliers who offer us like a cash discount. So the cash discount isn't necessarily you get a discount for paying cash. What it is it's a discount for paying early. So you may have a credit period of 30 days, and then they'll give you a discount period to say, but hey, if you pay within the first 10 days, you can take 2% off your invoice. So mathematically, companies would be better off to take that discount, even if they have to borrow the money for the 20 days to take it. Because again, you either pay it on day 10 or you pay it on day 30. So all you're doing is paying it 20 days early. And that's how the discount terms are written. So this is how you would read them. That's a 2% discount if paid in 10 days, net invoice is due in 30. And then you would find it on an invoice, like sometimes there are different little compartments, but as we look at this one, the block that says terms is what you're looking for. And then we'll talk a little bit about this freight box in a little bit too. But the terms again show you the if you have a cash discount. So 2% if paid in 10 days, net due in 30. Now then, how do we record that? So initially, when we get the invoice, we put it into the system, we debit merchandise inventory, and then we credit accounts payable. So again, think of our rules. We are setting up or increasing inventory by debiting it, and we are setting up or increasing our accounts payable by crediting that. Then we do pay it in 10 days. So we're going to take it completely out of our accounts payable for the full $500. We no longer owe it. Now we get a 2% discount. So 2% times the $500 equals $10, and that's our discount. And then instead of it going to a separate account called purchase discount, we just reduce the cost of our inventory. So we credit merchandise inventory for the amount of that discount. And then you always want to remember your cash is always the amount you owe less the discount. That's the only reason companies are taking that and paying it early, is so that they can save the cash. So always remember your cash is the amount you owe less the discount. Then you see it here post into the different T accounts. So again, we take it completely out of accounts payable, so our balance is zero. We've reduced the cost associated with the merchandise inventory, and then we've credited our cash. Now, if we didn't pay in the 10 days, so say we don't want to borrow the money and we don't have the cash available, we're going to take it out to the last day that we can pay it, and then we will pay it and debit our accounts payable and credit our cash. And again, that reduces our liability and reduces our cash accordingly. Then when we make purchases, many times we may have to return those. We could return them due to defective merchandise, or we could return it just because we've changed our minds or we bought too much or whatever. So we've got the Z-Mart issues a $30 allowance for defective merchandise. So then they're not going to pay. So we debit the accounts payable. It reduces what they owe. And then we take it out of our inventory because they were defective. We more than likely sent them back to the company. So then we take it out of our inventory. So then when we have the full thing, like here's if we purchase the $250, put it into accounts payable, we return $50 of it. So take it out of our inventory, take it out of our accounts payable. So again, if we credit inventory, we're reducing inventory. If we debit accounts payable, we're reducing our liabilities. Then we then take the discount on what's remaining. So then now, again, that happened within the first couple days, we returned the defective stuff. Now it's 10 days in and we're paying the balance due. So the balance due is $200. The $250 minus that $50 return leaves us that $200. And then we take 2% of that. So that's a $4 discount, and that reduces our cash and reduces our cost of the inventory. So then I mentioned when we looked at that invoice, there was a freight box on there. So the freight box is either going to say FOB shipping point or FOB destination. And depending on those terms, it determines who pays the shipping. So if it's FOB shipping point, the buyer pays the shipping. So at the shipping point, the seller is going to release all liability to the buyer. They've got to pay for the shipping. They've got to insure it during transit. And if they were taking an inventory count, it would be their inventory while it's in transit. FOB destination means the buyer doesn't assume any responsibility till it arrives on their property. So then that would mean the seller pays the shipping, the seller insures the product, and the seller would count that in their inventory again if they were doing inventory while it was in transit. Then this final column says, okay, well, how do we account for it? If we're the buyer, it just increases our cost of the inventory. We got to pay more to get it. So we debit merchandise inventory and credit cash. If we're the seller, it's a cost associated with selling. So we have an account called delivery expense, and we would debit delivery expense and credit cash. If Z-Mart purchased merchandise, again, on terms, and that transportation charge, FOB shipping point, and the transportation charge is $75, it's going to increase inventory, and then they're going to pay cash out. Then here just shows you a little list of all the things that could be included in inventory. So that would be all of our purchases, less the discounts that we have taken by paying early, less returns and allowances, and then costs of the transportation. So that gives us a total. The other thing that we have in these merchandising transactions is our cost of, or our gross profit analysis. So we've got our net sales, which would be our sales less those discounts, less any returns and allowances. That gives us net sales. Then we subtract out our cost of goods sold, and that gives us a gross profit. So now we get into actually the journal entries. So when we sell merchandise, it's going to be a double entry required. The first entry, we record the revenue of the sale and set up a receivable from the customer or receive cash. Then the second entry, we're going to reduce our inventory because, again, we're selling inventory out, and we're charging that to our cost of goods sold. So if we have sales that have no cash discounts to worry about, the first entry records the sale. So we debit accounts receivable, and then we credit our sales for the amount of the sale. Then if that merchandise had a cost to the seller of $300, they're going to debit cost of goods sold for that $300 and credit inventory for $300. Now, again, we can have the same thing where there's a sales discount. So now our customer could pay us in 10 days and receive a little discount. So you see the first two entries are the same, recording the sale and setting up the receivable. But then down below shows, okay, if they pay within the discount, we get the cash less the discount. So we give them a 2% discount times the $1,000 that we billed them. So it's a $20 discount. Our cash is reduced by the $20. And then now, instead of putting it to sales, we create a new account that we can analyze and keep track of, and it's called sales discounts. But it will be a contra sales account, which means it will have a debit balance. And then we credit our accounts receivable for the full amount paid. If they didn't take advantage of the cash discount, cash comes in for $1,000. And then accounts receivable is credited at the $1,000. Now we can also have sales returns and allowances, just like we had purchase returns. We can also have customers sending stuff back to us as the seller. So if a customer returns merchandise for $15 and it had a cost of $9, we now credit cash or credit their accounts receivable, depending on if it was on account or if it was paid in cash. And then we debit sales returns and allowances. So it's another new account that we set up so that we can properly analyze how many returns come back to us. And it too is a debit balance, so it's a contra sales account. Now, if the goods are not defective and they go back into our inventory, we do a separate entry that puts it back into inventory and then takes it out of our cost of goods sold, again at the cost, at the lower cost. Now, if it was defective goods, it would just come back as a sale returns and allowances. We would give them the cash back or reduce their accounts receivable, but we would not put it back into inventory because the goods are defective. So then now, how do we close the books for a merchandiser? So again, think back to chapter 3. We had our 4 entries of closing. So now it's basically the same, except for the accounts are a little bit different. So our first entry closes sales by debiting sales for the full amount and crediting income summary. The second entry is going to close all of our debit accounts. So notice you see all the expenses that we had in chapter 3. Now we have cost of goods sold, which is an expense to the company. It just relates to the inventory costs. And then we have those 2 contra sales accounts, sales discounts and sales returns and allowances. So even though those net up in our sales to create net sales, we close them with our expenses and our cost of goods sold because they're debit balances. Then we close the net income into our retained earnings, again via that income summary account. And then we close our dividends into retained earnings. So again, think of our statement of retained earnings, our net income closes into it, and then our dividends are paid out of it. So this is a nice little summary, and I would probably print this out if I were you. It shows you all of the normal entries if you're purchasing inventory, if you're paying with a discount, if you're returning inventory, if you have to pay shipping, all that stuff is in here. Then the same is true down here in the green. Now, what if I'm the seller? If I'm selling inventory, if I got a sales discount, if I've got a sales return, and then what if I'm paying the shipping? So this is another nice slide to print out and have handy when you're doing your homework and your test. Now, again, this gives you a little summary also, which again might be handy. This would be, like I said, with the perpetual inventory, there's definitely shrinkage. There's definitely error when you get to the end. So they may have to do an adjusting entry to charge things off to cost of goods sold and take them out of inventory if they no longer exist. These would be our closing entries that we just talked about. Again, the normal setup for those. And then now we have a multi-step income statement. So chapter 3, we had that classified balance sheet where we took our balance sheet and we broke it into more detail. This takes the income statement and kind of breaks it into more detail. So we'll have our sales less those contra sales accounts. So less sales discounts, less sales returns and allowances. That gives us our net sales. Minus our cost of goods sold gives us gross profit. Then you subtract out all of your expenses, and that gives you income from operations. Then you have your other revenues and expenses. So like your interest and your gains on sales, those are all separate and on the bottom. Total those up, and then that would come out to equal your net income. Now notice how it's set up though with to the left is our detail, and then we carry the totals over to the right. So again, the detail of all the selling expenses carried over to the right. Detail of all the general and operating expenses carried over to the right. So always kind of mirror that. Again, this might be something to print out and just have some of these key documents in a little file folder that you can pull them out and use when you need to. And then it compares it to what we had done in chapter 3, which was just that single step income statement. Now that we already did the classified balance sheet in chapter 3, this is just showing you that merchandise inventory is right in our current assets, right under accounts receivable. Then we have a couple ratios. So we have the acid test ratio, and that's our quick assets divided by our current liabilities. So our quick assets are things that quickly turn into cash. So cash, short-term investments, and receivables, and then divide that by current liabilities. So we do not include like our inventory or our prepaids, again, because those cannot be quickly converted into cash. Our gross margin is our gross profit, which is net sales minus cost of goods sold divided by net sales, and it'll give us a percentage. And then that percentage is nice to compare to other companies or to prior years to see how the company is doing from a financial standpoint. Okay, so that is chapter 4.